Welcome to the deep dive. Today, we're plunging straight into, well, a really powerful force shaking up the corporate world, hedge fund activism.
Yeah, it's basically where these investors, often pretty sharp-elbowed ones,
Yeah.
take a big stake in a company.
Right.
But not just to sit back. They actively push for, well, sometimes massive changes.
Exactly. Think of them as like super assertive shareholders with a very specific playbook and definitely a clear financial goal.
For sure.
So, our mission in this deep dive is really to unpack what hedge fund activism is, how it works, where these campaigns are really heating up globally,
Uh-huh.
what the real world impact looks like, and yeah, where the controversies are, because there are definitely controversies.
Absolutely. We'll get into the core ideas, the strategies they use, walk through some actually pretty fascinating real-world examples,
Yeah, the stories are key.
and look at how people actually try to measure if these campaigns genuinely deliver value or, if it's something else.
Okay, perfect. So, let's kick things off right at the beginning. What exactly is hedge fund activism? I mean, fundamentally.
Well, uh, at its core, it's a strategy. It's used by hedge funds, specifically. They buy up a noticeable chunk of shares, equity, in a public company.
Okay.
And their explicit goal, it's right there, is to influence things. Management, operations, maybe the whole company strategy,
I'm all aimed at.
all aimed at boosting the share price for their investors. And crucially, they're usually looking for that value boost, well, pretty quickly. Relatively fast timeline.
Okay, so it really boils down to pushing that stock price up.
Precisely. And that profit motive, that's really the key thing that separates this from other kinds of shareholder activism you might hear about.
Right, like NGOs or environmental groups.
Exactly. We're generally not talking about groups focused on social missions or ESG here. This is like fundamentally a financial play. A practical check is you won't find a donate button on their website.
Ah, right. Got it. Purely focused on the return. And there are some really big names that keep cropping up, aren't there? These major players.
Oh, absolutely. Elliott Management is probably one of the most well-known, maybe notorious for its aggressive style.
Yeah, you hear about them a lot.
Then you've got others like Starboard Value, Value Act Capital, Oasis Management, Jana Partners, Dalton Investments.
Yeah.
There's quite a few firms driving these campaigns globally.
Now, when we think about big finance, the U.S. often comes to mind first. But this isn't just an American thing, is it? Where are these battles actually happening?
That's a great point. It's definitely spread far beyond the U.S. I mean, the states are still the main playground, you could say.
Why is that? Just the size.
Yeah, largely the sheer size of the capital markets, plus the way many U.S. companies are owned, lots of different shareholders, quite dispersed. That makes them potentially easier targets. The U.K. is also a very active market for pretty similar reasons.
But you're seeing shifts, right? It's not static.
Oh, definitely. A really significant trend, maybe even a bit surprising, is the huge uptick in activity across the Asia-Pacific region, especially Japan.
Japan, really?
Yeah. If you look at the global share of activist campaigns, the U.S. percentage has actually dipped since around 2015. And just this year, 2024, campaign activity in APAC actually overtook Europe for the first time.
Wow, okay. That's a major shift in the landscape. Any particular reason for the rise in Japan?
Well, part of it seems linked to changes inside Japanese companies themselves. They're becoming more widely held by diverse shareholder groups.
Less concentrated ownership.
Exactly. Which kind of opens the door for outside investors who see chances to, shake things up and unlock value.
Okay, so we know who they are, roughly where they operate. This whole process, it sounds incredibly strategic, not just random. How do they actually pick a target, and what are they aiming for once they're in?
Oh, it's highly methodical, very calculated. They often run potential targets through this kind of filter. Sometimes people call it a four-line test.
Four-line test. Okay, break that down for us.
Sure. Line 1. Is there a clear path to making significant money, capital gains, by forcing change?
Okay.
They're hunting for situations where the company's current setup, its structure or operations, is clearly holding back value. Maybe it's a sprawling conglomerate that could be broken up.
Right, sell off parts.
Or a company sitting on a huge pile of cash that shareholders want back. Or maybe you could sell non-core assets, spin something off. They need to see a tangible way to unlock value the market isn't seeing right now.
So first step, is there hidden treasure somewhere?
Pretty much, yeah. Hidden value. Second line, Is it actually feasible to make the current board or management do these things?
Oh, the can we actually do it question.
Exactly. This is where they dig into the company's governance. Can they
Mhm.
win a proxy fight, get their own directors on the board? Are there other ways to exert influence? They're sizing up their chances of actually executing the plan.
Can they make the change happen? Makes sense.
That's it. Third line. Can they get support from other shareholders? This is crucial
Why is that?
because activists usually only hold a minority stake. They absolutely need backing from other big investors, especially the large institutions, if it comes down to a shareholder vote.
You
Building that coalition, making a strong public case, it's essential.
Right. They can't usually go it alone. Need allies.
Almost never. And the fourth line. What are the likely costs of doing all this versus the expected gain?
Ah, the practical side.
Totally. Activist campaigns can get really expensive. Lawyers, proxy solicitors, PR firms.
Yeah.
It adds up. So they do a cold, hard financial calculation. Does the potential stock price jump justify all the time, money, and effort involved?
Okay, very calculated indeed. So once they've picked a target and decided, yeah, let's go, what are the most common demands? What objectives pop up most often?
Yeah, looking at data from recent campaigns, say 2024, the number one objective, showing up in like 43% of cases, was M&A.
Mergers and acquisitions?
Right, often pushing for the company to be sold outright or maybe broken up or to sell off major divisions.
Mm-hmm.
Board changes were also incredibly common, targeted in about 31% of campaigns.
Trying to get their own people onto the board, I guess.
Precisely. That's often the goal there. Demanding capital return, so bigger dividends or share buybacks, that was sought in about 23% of cases.
Giving cash back to shareholders.
Yep. Changes to strategy and operations came up in 22%. And specific governance issues, like board structure or voting rights, were targeted in 11%. And it's worth remembering, pushing for governance changes is often a way to achieve other goals, like getting those board seats.
And just to circle back quickly, environmental stuff, ESG goals, rarely the main focus for these particular funds.
That's right. For these traditional hedge fund activists, it really is about the financial return, first and foremost. Their actions can sometimes even run counter to ESG objectives, which, yeah, we can definitely touch on again later.
Okay, this is great background. Let's try and bring it to life now with some actual examples. We've seen some really high-profile fights.
Absolutely.
Ah.
A good sort of classic example is Elliott Management's engagement with NN Group, the big Dutch insurance company. Elliott took a significant stake, and, while they might start out talking about constructive dialogue.
The friendly approach first.
Yeah, sometimes. But the underlying demands are pretty aggressive, pushing for major cost cuts, fundamentally restructuring the business, specifically demanding NN sell off its asset management unit.
So that initial friendly chat can turn pretty serious if the company pushes back. What's the usual escalation path?
Well, if they don't get what they want through those private talks, activists often ramp things up. The big weapon is usually a proxy contest.
Right, the shareholder vote.
Exactly. They'll nominate their own slate of directors to challenge the existing board at the annual meeting. Sometimes it's a short slate, just trying to get a few directors elected to gain influence. Other times, it's a full-on control contest, aiming to take over the whole board, or at least a majority.
And that gets messy.
Oh, yeah. Both sides hire these specialized firms, proxy solicitors, basically lobbyists for shareholder votes. It gets very public, very intense.
So how did the NN Group situation end? Did Elliott get what they wanted?
In that case, yes. NN Group ultimately agreed to sell its asset management business, actually to Goldman Sachs. And critically, the stock price saw a noticeable jump, that pop we talked about, right when Elliott's stake was first revealed.
Ah, so the market immediately reacted.
Exactly. It signaled that investors thought, okay, Elliott's here, change is coming, this might unlock value.
Interesting. Okay, let's shift continents. Japan Value Act Capital took on 7&I Holdings. That's the huge company behind 7-Eleven globally, right?
That's the one. And this case is fascinating because unlike Elliott's initial private talks with NN, Value Act's approach was very public right from the start.
How so?
They revealed their stake and immediately went public with their main argument, that the company's different businesses, the sum of its parts, was worth way more than the current stock price reflected.
And they didn't just say it quietly.
Not at all. They published this detailed public letter calling for, I think the phrase was, bold structural reform. Their big push was focus everything on the highly profitable 7-Eleven business and get rid of the other non-core retail operations. Wow. They even dropped this massive, like 98-page presentation laying out all their strategic and governance proposals in detail, demanding more outside directors, things like that, really putting it all out there.
That's definitely putting the pressure on publicly. So they pushed for a proxy fight, too. How did that end up for Value Act at 7 and I?
They did nominate directors, tried to oust some of the existing ones, but they actually lost the shareholder vote at the meeting.
They lost, so the activism failed.
Well, here's the really interesting part. Even though they lost that specific vote, 7&I's share price had already gone up significantly, something like 45% just since Value Act first got involved.
Whoa.
And the price didn't tank after they lost the vote either.
That's genuinely surprising. So they lost the battle, but maybe won the war, or at least the market seemed to think their ideas had merit.
It really suggests that sometimes the mere presence of an activist putting forward these arguments, applying that pressure, it can force the market, and maybe even the company eventually, to reevaluate the potential. And remember that shareholder structure in Japan we mentioned. High foreign ownership probably played a big role in how that campaign unfolded.
Fascinating. Anyway, one more scenario. Back in the U.S., the department store Kohl's faced what was called a wolf pack of smaller funds. What exactly is a wolf pack in this context?
Yeah, wolfpack is a term used when several activist funds, maybe smaller ones, independently target the same company around the same time. They might start coordinating their actions, sort of informally at first.
Why do that?
Well, it helps them build up a bigger collective stake and exert more influence than any one of them could alone. And sometimes they might try to do this while staying below the individual ownership level that requires formal public disclosure.
Trying to fly under the radar initially.
Sometimes, yeah. Though in the Kohl's case, it involved funds like Macellum, Ancora, Legion Partners. They eventually did formally disclose they were working together, so it became a notified Wolfpack.
Okay, so strength in numbers for these smaller players. What was their beef with Kohl's? What were they complaining about?
Their main issues, which they laid out very publicly, were about what they saw as poor performance. Things like stagnant sales, falling margins.
Yeah.
They also criticized the board, saying it lacked retail experience and took issue with executive pay, which they thought was too high.
Sounds like a common activist playbook.
Very much so. And initially, they pushed for a massive board shakeup, demanding 9 new directors.
9. That's almost the whole board. How did Kohl's handle that?
Well, it didn't get that far. The situation eventually got resolved through a settlement. The activists didn't get all 9 directors they wanted, but they did manage to get 3 of their nominees onto the Kohl's board.
So a compromise, but still a clear win for the activists in terms of getting board influence.
Exactly. It showed they definitely had an impact on the company's governance structure.
Okay, so we've seen the tactics, we've seen some different outcomes. This leads to the really big question. How do we actually know if this stuff works? Is it just about whether they get their demands met, or is there a measurable financial impact we can point to?
That's a great question. And yeah, researchers spent a lot of time trying to figure that out. They mainly use a couple of methods, mostly focused on, you guessed it, financial performance. One common tool is called an event study.
An event study. Sounds a bit academic.
It just means looking really closely at the target company's stock price movements right around specific key moments in the activist campaign.
Like what kind of moments?
Usually the big ones are when the activist first publicly reveals they've bought a stake, or later when a specific outcome of the campaign is announced, like a sale or a board change or a big payout.
And what do these studies typically find? What happens right when the activist shows up?
This is probably one of the most consistent findings in all the research. When an activist discloses their stake, the target company's stock price usually jumps. There's a positive abnormal return, often a sudden pop of around 6%.
6%. Just from them announcing they bought shares.
Pretty much. And it's seen consistently across different places, US, Europe, Asia. That 6% pop is basically the market reacting instantly, saying, okay, an activist is involved, they're probably going to force some changes, and that's likely good for the stock price.
So the market anticipates value creation.
Exactly. The size of that initial jump can even give you a hint about how likely the market thinks the activist is to actually succeed. And studies also show significant positive returns when specific outcomes are announced later on, especially things like board changes, major restructurings, and particularly if the company ends up getting bought out or if the activist achieves multiple goals.
Interesting. What about just getting a payout, like a dividend increase?
That's actually less clear-cut in some studies. Getting a simple payout alone hasn't always shown statistically significant positive returns around the announcement compared to, say, a major restructuring or a takeover.
Okay, so there's that immediate market buzz, and then maybe more gains if they achieve real structural changes. What about the longer run? Does the stock actually perform better over months or years because the activist was there?
Yeah, that's where researchers look at something called alpha generation. It's a bit more technical, but basically they use financial models to see if the target company's stock earns returns above what you'd expect, adjusted for risk, specifically during the time the activist is involved.
Trying to find that activist effect on long-term performance?
Exactly, finding the alpha.
And what does that research generally show? Do they find this alpha?
Often, yes, studies do find positive alpha.
Hmm.
But, and this is a really critical point that comes up again and again, this positive alpha typically shows up only when the activist actually achieves one of their main objectives.
Only if they win, essentially.
Pretty much. If the activist gets involved, makes noise, but ultimately doesn't get their demands met, there's often no alpha. Sometimes the stock even underperforms afterwards.
Wow. Okay, that's a powerful distinction. It really suggests the value isn't just because they picked an undervalued stock to begin with,
Right.
but because they successfully forced some kind of change.
Exactly.
Yeah.
It strongly supports the argument that these activists are genuinely involved in creating or maybe unlocking value through their intervention, not just being lucky stock pickers. A lot of the academic work in finance actually leans towards the view that, on average, activist interventions tend to improve the performance of the companies they target. People like Alain Brave have done influential work here.
Okay, that's really helpful context on measuring success. Let's turn now to some areas that maybe add more complexity and definitely more controversy to this whole world. We talked about Japan being a hot market now. Why was it historically so much tougher for activists there, even if they got that initial stock pop?
Yeah, historically in Japan, you'd often see that initial share price jump when an activist showed up,
Yeah.
just like elsewhere. But actually getting the changes they wanted, much, much harder.
Why was that?
It was often put down to the strong loyalty of traditional Japanese institutional investors. They tended to side with existing management. Plus, the whole structure of Japanese corporate governance, the kiretsu relationship sometimes, it just made it difficult for outsiders to force change.
But you said that landscape is definitely shifting now.
Oh, absolutely.
Yeah.
And pretty quickly, too. You've seen a huge increase in foreign institutional ownership in Japanese companies.
Yeah.
They don't have those same historical loyalties.
Right.
And maybe even more importantly, domestic Japanese institutions themselves are becoming more willing to actually support foreign activists, especially if they present a really compelling case for change.
Well, the shareholders are changing their tune.
Exactly. That fundamental shift in who owns the shares and how they're thinking is a major reason why we're seeing this recent surge in both activist campaigns and their success rates in Japan. I mean, success rates were pretty low between 2000 and 2019, but they've picked up. The 7i case, even though Value Act technically lost the vote, it really shows the kind of pressure Japanese companies are feeling now. It's a different ballgame.
Okay. We also mentioned wolf packs earlier with Coles. You said that was a notified wolf pack. What about the undisclosed kind? That sounds a bit more, well, shady.
It definitely raises eyebrows and sparks controversy.
Yeah.
An undisclosed wolf pack is when multiple activist funds coordinate their strategy, maybe share information, act together,
Yeah.
but they do it behind the scenes.
And the goal is?
Often it's to deliberately keep their individual stakes below the ownership level, like 5% in the U.S., that would force them to publicly disclose their position and the fact that they're acting as a group.
Why is it secret like that?
Well, it lets them build up a larger combined position in the target company, more quietly, and potentially more cheaply, before the rest of the market catches on and the stock price shoots up, because everyone knows an activist campaign is brewing.
And the controversy is about?
Companies and regulators argue this kind of secret coordination might violate securities laws. The rules that say groups acting together must disclose their collective stake above a certain threshold.
But the activists have a counter-argument.
Of course. They usually push back hard. They might argue they're just independent investors who happen to see the same opportunity at the same time. They're not formally a group acting in concert. Someone once used the analogy, it's like going to a Grateful Dead concert. Lots of people show up because they like the same music, but it doesn't mean they're an organized group.
Huh. Okay, I get the analogy. Now, there's also a completely different beast. Short activism, where you're actually betting against the company.
Right. Totally different approach. Short activism is where the activist takes a big short position in the stock.
Meaning they borrow shares, sell them.
Exactly. Hoping the price will fall so they can buy them back cheaper later and pocket the difference. Then, the key step is they publicly release negative information research reports Allegations trying to actively drive the stock price down.
And they profit if it works, if the price crashes.
That's the goal. And studies do show a significant negative stock price reaction when a well-known short activist comes out with their position and their negative report.
Does it always work? Or does the type of allegation matter?
Research suggests it's much more effective when the short activist makes really specific and serious claims. Things like uncovering accounting fraud, major scandals, pointing out something that looks like a pyramid scheme like with Herbalife years ago, or Enron even further back. Just saying, oh, this company is generally overvalued, that tends to have way less impact than concrete allegations of wrongdoing.
That definitely feels more inherently controversial than standard activism.
Oh, it is. Highly controversial. Short activists are constantly facing accusations of market manipulation, of spreading false or misleading information just to make a profit. They might argue they're performing a service, acting as watchdogs uncovering fraud, but it's a strategy that generates a ton of lawsuits and backlash.
Yeah, I can imagine. Okay, final point on these special cases, let's revisit that ESG angle we mentioned. We established traditional activists are mainly profit-driven. Do their actions ever directly clash with environmental or social goals?
Yes, absolutely. Because maximizing that financial return is the #1 priority, their strategies can easily, and often do, conflict with broader ESG objectives.
Can you give some examples?
Sure. Look at investments in fossil fuel companies. Funds like Elliott have been involved with companies like Suncor, Phillips 66, Marathon Petroleum. And often, the push is for strategies that maximize the short-term cash flow from those existing fossil fuel assets.
So double down on oil and gas, basically.
Or at least prioritize extracting value from them now, rather than investing heavily in transition. Elliott Management, for instance, was a big investor in Peabody Coal. And they reportedly pressured BP quite heavily to scale back, maybe even reverse some of its clean energy investment pledges.
Why?
The argument was basically that those green investments weren't generating enough shareholder value quickly enough compared to their traditional business.
So even while lots of investors are talking ESG, the core hedge fund activist model, for the big players anyway, remains firmly focused on profit first, potentially even pushing companies away from ESG goals.
For the large, established, profit-maximizing funds we've mainly discussed today, yes, that's largely the reality. Now, there are some newer, smaller funds trying to build an ESG activist model, but that's not characteristic of the main players like Elliott or Starboard. Many companies targeted by traditional activists, especially in sectors like energy, are actually high emitters and pretty far from being aligned with climate targets.
Okay. This whole world of activism, it's also deeply tangled up with the bigger picture of corporate control, M&A, companies being bought and sold, isn't it?
Absolutely. It's fundamentally intertwined. Activists often use the threat of a proxy fight or actually winning board seats as leverage. And once they have that influence, that foot in the door,
Then what?
then they can push much more aggressively for things like a full sale of the company or major divestitures. And since takeovers usually happen at a premium price for shareholders, pushing for a sale is a very common and potentially very profitable goal for activists.
And they might use board seats to clear the path for a sale.
Exactly. Sometimes they might specifically target board seats to try and dismantle takeover defenses the company has put in place. Things like poison pills, which are designed to make a hostile takeover really expensive or difficult.
Wow.
Activists might want those gone to make the company an easier acquisition target.
Right. This really brings us to that central, ongoing debate around hedge fund activism, doesn't it? Does it truly create genuine long-term value for the company and everyone involved? Or is it more about financial engineering that just transfers wealth around, maybe even harms some groups?
That's exactly the core debate. And opinions are really divided. The view you often hear from within finance, from academic finance literature, and obviously from the activists themselves, is that yes, it's a positive force.
How so?
The argument is they improve corporate efficiency, they shake up complacent management, they strengthen governance, make sure capital gets allocated better, ultimately benefiting all shareholders by providing that crucial discipline and oversight.
Okay, that's the pro-activist case, but there's definitely a strong counter-argument.
Oh, absolutely. Critics argue that this intense focus on boosting the stock price quickly on those short-term financial gains can lead to really negative outcomes elsewhere. Well, potential harm to employees is a big one. Aggressive cost-cutting often means layoffs. Critics also point to the risk for debt holders. if activists push companies to take on more debt or pay out huge amounts of cash.
That increases the risk for bondholders.
Exactly. It makes the company potentially riskier for those who've lent it money. Some studies have even shown that just the threat of activism can actually lead to losses for existing bondholders.
Interesting. What about long-term investment?
That's another major point of debate. Does activism encourage short-termism? Does it make companies cut back on long-term investments like R&D, innovation, things that might pay off years down the road but hurt profits now? Some research does push back on that, suggesting activism doesn't universally harm innovation, but it's a persistent concern. Some skeptics also suggest the gains might just be clever financial maneuvering, like using debt to get tax breaks, rather than fundamental improvements in how the business runs.
And you mentioned earlier there can even be effects on companies that aren't targeted, spillover effects.
Right. There's research suggesting that companies might watch an activist go after a competitor in their industry and think, oh, we could be next. So they might proactively improve their own governance or try to boost their efficiency just to avoid attracting that activist attention themselves.
Which could be seen as good or bad, I suppose.
Exactly. You can see it as spreading good practices or as spreading that short-term pressure across the whole sector.
So it's clear the motivations are complex, the consequences are really debated, but the fundamental driver for most of these funds seems pretty straightforward.
Yeah, I think it's fair to say that for the vast majority of the traditional hedge fund activists we've been talking about, the bottom line is clear. It's about financial return for their investors. That profit motive is the engine, and it often seems to override other considerations, whether it's social impact or environmental concerns.
Well, we have certainly covered a lot of ground today. We've defined hedge fund activism, tracked its really surprising global spread, especially that rise in Japan. We've dissected the methodical way activists choose targets and the kinds of things they push for.
Hmm.
We brought it to life with those examples like NN Group, 7&I, Coles, explored how success is measured, looking at market reactions and that long-term alpha.
Yeah, the measurement part is key.
And we dove into some of the trickier, more controversial bits: Japan's evolution, wolf packs, short activism, and that distinct lack of ESG focus for most traditional players. And finally, we touched on that huge ongoing debate: does it create real value or just move it around? Plus its links to M&A and corporate control.
It really is a powerful and, yeah, often very disruptive force in today's markets.
It absolutely is. So as you, our listener, think about this really dynamic world of hedge fund activism and its undeniable impact, maybe consider this question. How should that core drive to maximize shareholder value, which is clearly the main goal for these activists? How should that be balanced against the interests of all the other people involved? You know, the employees, the debt holders, the communities where these companies operate, maybe even the environment. How do we balance all that when deciding how corporations should be run? Thanks for joining us for this deep dive.
Yeah, thanks for tuning in.